Standard, this is IFRS 13, fair value measurement. Um, Fair value measurement, it is related to measurement of assets and measurement of liabilities, but mostly we will be focusing on measurement of assets. And we know that there are many different standards which have the option of being measured at fair value. So therefore, this one standard, it actually applies to many different standards. And of course, there are some exceptions as well. So there are assets which can be measured on fair value. And there are, of course, some assets which cannot be measured on fair value. So those are exceptions. I'm sure that you people have some idea about what is fair value. I mean, sometimes we think that it's the market value, or you know, some understanding you do have from your past, but let's see it in more detail. So why IFRS 13? The purpose, objective of IFRS 13, objectives are to define the fair value so that you get the the exact definition, the accurate definition of what is the fair value. What do you mean by fair value? To set out in a single IFRS a framework for measuring fair value in a single IFRS, because in many standards you use this fair value measurement. So we put everything together in one, and then we we show that how different assets or different liabilities, how the fair value applies on those different standards, and to require disclosures about fair value measurements. So these are the three main objectives. So fair value, it's a market-based measurement, not an entity-specific measurement. So market-based, like you have book value, you have carrying value. If you remember, if you go back and we talk about, how to say, the cost model of recording your assets, which says that historical cost minus the accumulated depreciation or any impairment losses, that is called entity-specific measurement. Entity-specific measurement, it comes from historical cost, or maybe you have value in use. So you think that how much is the value of asset from your own perspective, okay? From an entity's perspective, from your perspective. Fair value is not entity specific. It is about market specific, that how the market sees your assets or liability. It's not about your internal evaluation. So it shall look at the market participants. So we would be learning the word market participants would look at the asset or liability under measurement and shall not take own approach into account. So own individual entity specific approach will not see, will see that how market participants, they see it. And this is the notion of an exit price. We will use the word exit price. Exit price means that the price which you pay to acquire an asset or to settle a liability, exit price. When you are, getting away with the asset, or when you are getting away from a liability, that price is called exit price. We have an entry price. So there will be a lot of terminology which we will be learning in this standard. A lot of new words, new terminology. One is that exit price, and we will see what exit price is. So what is fair value? Now, this is the typical definition. Fair value is the price that would be received to sell an asset or paid to transfer a liability, the exit price, in an orderly transaction. Orderly transaction means that it is not a forced sale between market participants, which are market-based view, at the measurement date, which means the current price. So these words which we have put into red color, these are the words which you need to focus. Sell an asset or transfer a liability in an orderly transaction between the market participants at the measurement date. Measurement date is very important because this is something. Now, before I move forward, I want to share with you the weaknesses of the new and old definition of fair value. The fair value is a market-based measurement. It is not entity-specific measurement. Consequently, the entity's intention to hold an asset or to settle or otherwise fulfill a liability is not relevant when you measure the fair value. So What does that mean? Because it's an entity, it's not entity specific, it is market based approach. So whatever value you assign to the asset based on your value in use, your economic value, your recoverable amount. You remember we did that recoverable amount thing. So that was your own calculation. That was your own estimation. That is called entity based measurement. When you speak about fair value, your entity based measurement, it becomes irrelevant. We only speak about the market specific. We talk about market based measurement. Let me share with you the old definition of fair value and its weaknesses. The old definition of fair value was this one, okay? It said that the amount for which an asset could be exchanged, it was written in the standard and it was written in your books as well. The amount for which an asset could be exchanged or a liability settled between knowledgeable willing parties in an arm's length transaction. Arm's length transaction, we use the word. And this definition, of course, has some weaknesses. The weaknesses are, it did not specify whether an entity is buying or selling the asset. So it says for which an asset could be exchanged. So for a buyer or for a seller, there is a different perspective. But we said that it could be exchanged. So it does not specify whether you are buying the asset or you are, selling the asset. It was unclear about the settling mean, what settling meant, because it did not refer to the creditor. So liability settled. Again, how do you settle the liability? That's the question. And it was unclear about whether it was market based or not between willing parties. So maybe it is not market based, it is just between A and B. And then it did not state exactly when, because it said at an arm's length transaction, but the price would be measured on which date. Now, the date was not clear when it will happen. Now, after seeing this definition, if you go back to the definition of fair value and then you read it again, then it makes more sense. Okay, I go back. You see here, it says that at the measurement date, in previous old definition, measurement date was not there. Between market participants, this is the focus, sell an asset or to transfer a liability in an orderly transaction, So the wordings have changed, and of course the new wordings, they make more sense. It becomes more specific, more accurate. Now, classification, recognition, and measurement. What I want to show you here, that these are different types of assets, okay? I just put this diagram. It is not available in your book, but I just took it and put it here to show you that how the fair value thing, it impacts different standards. You've got different, your IFRS standards here. This is your property, plant, and equipment. We call it IAS 16. This is the initial recognition. You measure it at cost. The first line is initial recognition. The second is subsequent recognition, which means at the reporting date. This is at the purchase date. This is when you prepare your financial statements. So how do you value your IAS 16 assets? Of course, at initial recognition, it is on cost. And then at subsequent recognition, either you use the cost model or you use the revaluation model. And I will tell you the difference between cost model and revaluation model. Okay, this revaluation model, you know that in your IAS 16 tangible non-current assets, end of the day, end of the year, when you have, which you call reporting date, which is also called subsequent measurement, either you can keep the cost model. Cost model means the historical cost minus the depreciation and impairment losses, etc. But you keep it on the balance sheet value. You call it net book value. You call it carrying value. Or IAS 16, it gives you option to show it at revaluation model, which means that you take the fair value, the market-based approach, and you show it there. But the difference, and you do not show it at fair value, by the way. If you pay attention, IAS 16 does not allow you to use fair value. This is a revaluation model. The difference between revaluation model and fair value is, you should remember that in revaluation, you are also increasing the price. You are also increasing the value of the asset. But then you will start charging depreciation on the revalued amount, on the new amount. Fair value does not have depreciation. Whenever you measure an asset at fair value, you do not charge depreciation on fair value. You just see the difference in the fair value, changes in the fair value. If the fair value goes up or the fair value goes down, you record some changes in the fair value as gains or losses. But revaluation model, it also takes the fair value thing, the market thing, but you consider it revaluation model, and then you start charging depreciation. So for your PPE, you do not have fair value thing. You have only two options. Either you keep it at the balance sheet value minus the depreciation impairment, or you adjust it with the market value, increase the price of the asset, and then keep on calculating the depreciation based on the new valuation. This is your IAS 16 property, plant and equipment. Then you've got intangible assets. Intangible assets, initial recognition is at cost, and then subsequent recognition, again, either cost model or revaluation model, just like what you did in IAS 16. So tangible non-current assets, intangible non-current assets, IAS 16, IAS 38, they have the similar treatment. And I put here nil. Nil means that there will be some intangible assets which you will not recognize. They will not have any initial measurement, and they will also not have any subsequent measurement. Some type of internally generated customer lists or internally generated some other assets for which you do not have third-party valuation. If you do not have third-party valuation, then you do not recognize them. So this goes with your tangible assets and intangible assets. Then you have got investment property. Investment property is IAS 40. Initial recognition is always at cost. Subsequent recognition either at cost model or at fair value model. It does not have revaluation. It has fair value. Now, the difference in fair value means that you will take the market-based approach, but you will not be charging depreciation. Like fair value model has no concept of depreciation. So you can choose fair value model. Now, what is, so here in IAS 16, cost or revaluation, here cost or fair value in IAS 40, okay? This is your IAS 40, investment property. Now, if I come back here, here the priority is given to fair value model. I mean, IAS 40, it says that it is better that you do the fair value. I mean, if you cannot use fair value model, then you can go for cost model. But ideally speaking, cost model is not something which is recommended. You've got financial assets under IFRS 9. Initial recognition is at fair value. Initial recognition, there is no cost concept. Initial recognition is at fair value. And subsequent recognition, you go at either the amortized cost or you go the fair value model. And amortized cost we did in IFRS 9. Those of you who have not watched the video, they will watch the video and they will understand, and we will actually do it once more. Then you've got IAS 41, which is biological assets. Fair value less cost to sell. So this is kind of NRV. You can remember and you can relate it to NRV type of thing. Fair value less cost to sell. And then subsequent measurement is also fair value less cost to sell. Then you have inventories, which is IAS 2. Initial measurement is at cost, and then subsequent measurement is lower of cost or NRV. Lower of cost or NRV. And we know that NRV means selling price minus expenses to sell and expenses to complete. In some cases, we use fair value model as well. Like when you have some other, how to say, IFRS 5 assets, non-current assets held for sale or discontinued operation, because there are some cases where inventories are not purely your inventories, some other type of assets, they are converted to inventories, then you can use fair value model as well. And then there are some, etc. Like I told you, different standards here, like IFRS 5 comes in here. You have defined benefit. This is your IAS, IAS 19, employee benefit. Fair value planned assets less your planned costs, obligation, and arbitrary rules. So you use fair value in IAS 19 employee benefit as well at the initial recognition and also at the subsequent recognition. So this is overall one summary Of course, we are not going to apply all of this in one chapter because these are all, we have separate different chapters. So we will be discussing them within these standards. The purpose of showing you this thing is that how fair value is related to multiple standards. And there are some differences which you should be noticing very, very, how to say, keenly, that IS 16, there is no concept of fair value, whereas IS 40, investment property, is at fair value. And similarly, some other things. And there is one more summary, which I will show you in the table format. And that will look like this. You have asset type. It's again the same thing, but these are the most common things which I put on one sheet. So when you have IFRS 9 financial instruments, you put fair value, initial recognition, and then you go at fair value. Model based on fair value, you take fair value. IS 16, you can do either cost model, or you do revaluation model or cost, or you can do in IS 38 revaluation model. You have option with you. You cannot use fair value model here. You do revaluation model, and so on. You can review this thing, this sheet. It is almost the same thing, but I just put it in another format. Now, let's start the standard now. IFRS 13, when an entity performs the fair value measurement, must determine all of the following: the particular asset or liability for which it is calculating the measurement, consistently with its unit. For example, for a non-financial asset, the valuation premise that is appropriate for the measurement, consistently with its highest and best use. This is a terminology which HBU, we call it HBU. This is, maybe you are getting first time you are interacting with this thing. We call it highest and best use. What does that mean? I will explain you. So these are the definitions which we are going to learn today. The principal or most advantageous market for the asset or liability. So this is again another terminology which comes with IFRS 13. You call it principal market, or you call it most advantageous market. The first option is always principal market, the market in which the asset is primarily sold and bought, and then most advantageous market. And we will do some example also to understand the difference and how to measure the asset within the principal market or in the most advantageous market. Valuation techniques appropriate for the measurement. So different valuation techniques are there. We will learn different valuation techniques. Availability of data with which to develop inputs. Where are we taking the prices? This is something we will focus at. And fair value hierarchy within which inputs are categorized. So there are different level 1, level 2, level 3 inputs. So there are 3 levels of information coming to us, and there is a hierarchy of that. So level 1 is the first choice, level 2 is the second choice, and of course level 3 comes as the third choice. This is, I'm just putting a summary. We are going to discuss all of these things one by one, like valuation techniques, fair value hierarchy, and etc. So asset or liability. The asset or liability measured at fair value might be either a standalone asset, an individual asset, some individual asset, or probably it is a group of asset, a group of liabilities, or a group of assets and liabilities, both. It could be an investment in a business. When measuring fair value, an entity takes into account the characteristics of the assets or liability that a market participant would take into account. So a market participant, what factors, what characteristics they would consider, and these characteristics usually are the condition and location of the asset. Very important. What is the condition of the asset and what is the location of the asset? Location is also very important. The restrictions on the sale or use of the asset. If there are any restrictions, any legal restrictions on the sale of the asset. Transaction. A fair value measurement assumes that the asset or liability is exchanged in an orderly transaction between market participants at the measurement date under current market conditions. The transaction is orderly. So what do you mean by an orderly transaction? Because when we were doing the definition of fair value, we said that in an orderly transaction. So let's define the orderly transaction. What do you mean by that? An orderly transaction means that there is adequate market exposure in order to provide market participants the ability to obtain knowledge and awareness of the asset or liability necessary for a market-based exchange. So we call it like well-aware, knowledgeable parties. In the old definition, there was a terminology we used, knowledgeable parties. So that knowledgeable parties means that people, they have sufficient information about the asset and liabilities, and about the valuation of such assets and such liabilities. Market participants, the word again we used. Market participants are motivated to transact for the asset or liability. They are not forced. So there should be, when if you remember in the old definition, we called it in an arm's length transaction. So this is kind of arm's length, which means that two parties, knowledgeable parties who have information about the market, they are buying and selling some asset or liability with their willingness. They are not forced. They are not, the decisions are not biased. The decisions are neutral. Okay. So we call them arm's length transaction. Here we use the word as orderly transaction. Orderly transaction mean without any pressure between two parties who are equally knowledgeable. Market participants are buyers and sellers in the principal or the most advantageous market for the asset or liability with the following characteristics. So who are the market participants? So far we are defining the vocabulary and the language of the standard. They are independent, unbiased, knowledgeable. They are able to enter into transaction. So they have the capacity to enter into such transaction, and they are willing to enter into transaction. So this is the definition of market participant. Individual parties who are knowledgeable, who have the capacity and willingness to enter into transaction. So what is their judgment? So like in market, such buyers and sellers, like who are independent, knowledgeable, having the capacity and willingness to buy or sell the liabilities or assets. So those we call them market participants, and the transactions between them are called the orderly transactions. Principal versus most advantageous market. These are two more definitions how to define what is principal market and what is the most advantageous market. Principal market is the market with the greatest volume and level of activity for the asset or liability. Different entities can have different principal markets, as the access of an entity to some market can be restricted. So companies, they have different, principal markets. Like if we talk about stock exchanges, these are principal markets in which, financial assets or financial liabilities are bought and sold. And different entities, they have access to different markets. For example, you are a UK based company, you have access to UK stock exchange. Probably there is another market also there. And then if you talk about, if you are a commodity trader, for you, your local market will be your principal market. That commodity is sold in some other market also, but for you, the local market could be your principal market. And then you have most advantageous market, is the market that maximizes the amount that would be received to sell the asset, or minimizes the amount that would be paid to transfer the liability. So it is possible that in principal market, you have valuation of asset less than the most advantageous market. I mean, in your local market, like I told you, that if you're a commodity trader, for you, your local market is principal market, and the value of your commodity probably is $100. And there could be a most advantageous market in which the same commodity is being sold at 105. But for you, the principal market is here. But there is another market as well, but that market you do not have, easy access. It's not your principal market. For you, this particular market is most advantageous market. So two definitions, principal market and most advantageous market. Okay, so we move forward. Application to non-financial assets and liabilities. You may have non-financial assets, okay? Um, Fair value of a non-financial asset shall be measured based on its highest and best use. From a market participant's perspective, the highest and best use takes into account the use of the asset. That is, now what is highest and best use? Physically possible, that takes into account the best use of an asset as physically possible. It takes into account the physical characteristics that market participants would consider, for example, property, location, or size. So this is physical characteristic. Legally permissible, it takes into account the legal restrictions on use of the asset that market participants would consider. For example, zoning regulations. There are some regulations, there are some restrictions on usage of certain types of asset in certain markets. Like there are some equipment which use different types of fuel, and there are some fuels which are not permissible in EU market, like the high carbon emission fuels. They are not permissible in EU market. So if you have any equipment which is running with, high carbon emission, probably diesel, that would not be legally permissible. Financially feasible, it takes into account whether a use of the asset generates adequate income or cash flows to produce an investment return that market participants would require. This should incorporate the cost of converting the asset to that use also. So highest and best use means that you consider the physical condition or the physical possibility of the asset, the legal permission of that asset, and the financial feasibility, that if you start using the asset, what output or what income or what cash flow it will generate. So these are other three conditions. Application to financial liabilities and own equity instruments. So you may have liabilities and own equity instruments. A fair value measurement of a financial or non-financial liability or an entity's own equity. Okay, financial liability or a non-financial liability. You may have a financial liability of delivering cash or delivering, some currency, or you may have a non-financial liability of delivering some goods. This is a non-financial liability. Or an entity's own equity instruments assumes it is transferred to a market participant at the measurement date, without settlement, extinguishment, or cancellation. Now, what does that mean? It means that in the first instance, an entity shall set the fair value of the liability or equity instrument by the reference to the quoted market price of the identical instrument, if available. If the quoted price of identical instrument is not available, then the fair value measurement depends on whether the liability or equity instrument is held by other parties as assets or not. So if it is held by some other party as asset or not. If the liability or equity instrument is held by other party as an asset, then if there is quoted price in an active market for identical instrument, so take the quoted price. If there is no quoted price in active market held by the party, then use observable inputs. Like, what do I mean here? You probably have issued some bonds. So the bonds are your financial liabilities, but somebody else has purchased those bonds, and for them, it is their asset. So how do you treat those bonds? The valuation. You see the market value of the bond. Probably the face value of the bond. It is possible that the face value of the bond probably is, I'm sorry, what is bringing me in? The face value of the bond maybe is $100. Okay, it may be $100 written on the bond, $100. But you see that what is the market value of the bond? If the bond is traded in the market, if it is quoted in the market, probably the market value is only $90. So you are taking $90 in your books. So that's a liability. That's a liability instrument. Okay, and the same happens with your equity instruments as well. So if there is the quoted price in the active market for the identical instrument held by another party, then use it. If there is no quoted price, then you can make adjustment and then use it. If the liability or equity instrument is not held by other party as an asset, then use a valuation technique from the perspective of market participants. So this is the application for financial liabilities. Here we call it fair value hierarchy. Now, there are three levels of input. Three level of input means that where are you getting your prices? Let me first show you the level of inputs, okay? When you define the fair value, so level of input means that how you determine the fair value. So there is first level, which means your first choice, your first option. Level 1 inputs are quoted prices, unadjusted. You don't make any changes in active markets for identical assets. For instance, you purchase some bonds or you purchase some shares. So what are the quoted prices of those bonds and shares in market? Maybe you have some other commodity, you have some other asset. So what are the prices of, like, probably when I say commodity, maybe you are speaking about cotton, you are speaking about gold, you are speaking about oil. So you talk about the best thing is level 1, which means that you take the market price, the quoted price. And if you have this particular asset being quoted in the market, take the market price. This is level 1. This is the most recommended level. This is the most reliable level of determining the fair value. If it is not available, then you come to level 2. Level 2 are inputs other than the quoted prices, because it is possible that you have made investment in a company whose shares are not bought and sold on stock exchange. It's a private limited company. So they are not available. Quoted prices are not available. So then what you do, that you say that within level 1 that are observable for the asset, either directly or indirectly, quoted prices of identical assets or liabilities in active or inactive markets. So if you remember that when we were doing your paper FM, financial management, we did valuation. And we said that if you are investing in a company which is unlisted company, what you do, and you need to do valuation of an unlisted business or unlisted share. So what you do, that you find out a similar market, similar company, a similar share, which is in the same industry, but it is listed. So you make reference from some other point. You make reference from some other, quoted share. Then comes level 3. Level 3 inputs are unobservable inputs. So we say that these are quoted inputs. These are observable. That even though they are not quoted in the market, but they are observable. You can observe them. And level 3 inputs are totally unobservable. These are for unobservable inputs for assets and liabilities like financial forecast, historical volatility. So you make some other changes. You do your valuation, you determine your fair value based on some, financial analytics, financial forecast, and some other. So these are 3 levels. Of course, determining fair value with level 1 is the first choice. And the standard says maximize the use of level 1. Maximize the use of level 1 and minimize the use of level 3, because level 3 is very subjective. Level 3, you cannot have a reference to that. It is something which has been derived by yourself or probably by some individual assessor. So this is called level 1, level 2, and level 3. If I go back to the graph which I was showing you, the table. So this is what I was showing you before. We say that, is there a quoted price in an active market for an identical asset or liability? This is level 1. If it is yes, use the level 1 input, which means take the value from the market, and must use without any adjustments, maximize the use of relevant observable inputs. Observable inputs include market data, prices, and other information that is publicly available. And unobservable inputs, you have to minimize the use. If there is no quoted price, no. Then are there observable inputs or not? If observable inputs are available, go to level 2, which means that take some identical or similar assets and then refer to them and create your own valuation. And if observable inputs are also not available, then you do level 3. Then you do level 3 input, which are your financial historical information, and based on that you calculate it. Non-performance risk is there. It is possible that when you talk about liabilities, liabilities are owed by some people, and it is also possible that those parties, they may lack, or they may, you know, fall in the performance of those obligations. So while measuring your financial liabilities, you should also consider the risk of non-performance. And it says that the fair value of a liability reflects the effect of non-performance risk. I mean, there is a debt instrument, and that instrument, the fair value of the debt instrument, it should also include the risk of default, the risk of non-performance. Non-performance risk includes, but is not limited to, entities' own credit risk. And how do you determine this? Because you should understand that different entities, they have different how to say, credit ratings. Okay, let me do it. There is a bond. Okay, there are two companies. This is company A and company B. It is possible that company A, it has a rating of triple A probably, and their risks are different, and this company has the risk of the credit rating of triple B. Here the discount rate will be different, and here the discount rate will be different. It is more secure investment. The debt issued by triple A is definitely has better credit rating, and therefore a different discount rate, and here it has a different discount rate. So sometimes when you shift it, you need to take effect of the discount rates as well. We will show you with the help of some examples, some numbers, how to apply it. But it is not limited to entities' own credit risk. So credit risks are changing. For example, the risk of non-performance can be reflected in the different borrowing rates for different borrowers due to their different credit ratings. As a result, they would need to discount the same amount with the different discount rate. Thus, the present value of a liability would differ. If you remember that we always calculated the present value of the liability based on the effective interest rate or based on that discount rate. And because entities, they have different credit risks, therefore their discount rates are different, and ultimately their present value of liabilities will be different. Okay, you should not be getting worried about it, because as far as your exams are concerned, when you were doing your F7 paper, they were giving you the fair value. They said that the asset or the liability has, this is the book value, this is the fair value. They gave you the fair value. You never calculated, and you never even picked up. They just gave you. In this particular case, in your SBR, they will not tell you exactly what is the fair value. They will give you some numbers, and you will have to make an option that are you going to take it from the principal market, or are you going to take it from the most advantageous market, and how to calculate. So numbers they will give you, you will just have to put them in place. Okay. And transfer restrictions and demand feature. It is also possible that sometimes on liabilities, there are some transfer restrictions. An entity shall not include a separate input or an adjustment to other inputs relating to the potential restriction preventing the transfer of the item to somebody else. So you leave it unadjusted, whatever it is, it is. So forget about the transfer restrictions. But demand feature is also there. The fair value of a liability with a demand feature is not less than the amount payable on the demand discounted from the first date that the amount could be required to be paid. So demand restriction means that when, for example, if you talk about bonds, they all have a demand feature. investors or the lenders, they have a right to demand, and you need to calculate that how much they will be demanding. So if I'm going to redeem the bond at the face value, or even if we are going to redeem the bond at premium, so whatever is the value, you have to discount it to the present date. So this is what you call demand feature, and you discount it with that particular period and bringing it to the present value. Fair value at initial recognition. If you remember that we have this financial assets IFRS 9, their fair value is based on initial recognition, is also based on fair value. When an entity acquires an asset or assumes a liability, the price paid or received or the transaction price is an entry price. So when you are buying something for the first time, you enter into a transaction, it is called transaction price or it is called the entry price. This is when you become party to an asset or you become party to a liability. But then what happens that, however, IFRS 13 defines fair value as the price that would be received or sell the asset or paid to transfer the liability, and that is an exit price. So your transaction price or entry price is when you acquire it, but fair value means when you are exiting from that asset or exiting from that liability. So fair value is focusing on the exit price. It's not talking about here, we are talking about how much will be the exit price. So then what happens, it says that in most cases transactions are entry prices equal to exit price, like the initial price. Initially, they are actually equal. I mean, on the date of purchase, on the date of transaction, it is quite possible that your entry exit price is same. Like I purchase a bond today for $100 and I can sell it for $100 today. In many cases, it is possible that I go to the market and today I got it, and the very next moment, if I want to sell it, I will sell it again for 100. So entry exit prices would be same. But there are some situations when transaction price is not necessarily the same as exit price. So there are some possibilities that the transaction price and exit price is different. For example, I am buying the bond at 100, but if I want to sell it immediately, probably I will not be able to sell for 100, maybe little less or maybe little more. The transaction happens, and why does it happen? Why does it happen? The reasons. Number one, the transaction happen between related parties. You know that we have done this standard in IS, in F7 as well, related parties thing. Related parties are like the parties which have influence over each other. They somehow are related to each other. Group companies could be there, and there are some other reasons also for being called them related parties. Here you can assume that these are group companies. So when a group company will buy or sell asset to each other, it is possible that the price which is charged, maybe it is not the market-based price. Maybe it is given at probably some, favorable terms. So in that case, entry and exit price will become different. I mean, if I buy an asset from another group company, probably it was given to me on a favorable terms. I get it for 100. My transaction price is 100. But if I want to sell it now in the open market, I may be able to sell it for 110. So this is a case where the entry price and the exit price are different. It is also possible, the difference, that the transaction takes place under duress, or the seller is forced to accept the price in the transaction. It is also possible that sometimes the sellers are forced to accept the price in transaction, or the buyers are are forced to accept the transactions. Probably some selling of some, loans, selling of some debts, it is possible. The unit of account represented by the transaction price is different from the unit of account for the asset or liability measured at fair value. The unit of account means the asset which is sold in whatever unit. Ultimately, so there is a different unit for which you are measuring for fair value. You are selling something on probably, in barrels, and maybe you are measuring something in gallons. So it is also possible, because you purchase in gallons and you are selling in, you purchase in barrels and you are selling in gallons. So unit of account could be different. And the market in which the transaction takes place is different from principal or the most advantageous market. It is like, it may not be the principal market, it may not be the advantageous market, it's a special market between certain parties. So then, because market is different, so prices will be different. You purchase it in a different market and you sell it in a different market, then it is possible that there could be some difference between the entry and exit prices. If the transaction price differs from the fair value, then an entity shall recognize the resulting gain or loss as day one profit to profit and loss, unless another IFRS standard specifies other treatment. So if this happens, so immediately you are buying it and you are making some gain or you are making some loss, you immediately record it to your, your P&L as day one profit or day one loss. So this is what it happens. If you remember that when we do some bargain purchase on some goodwill, when you purchase some business at a price or at a value of lower than the net assets, and there is a case of negative goodwill happening, so there is something which is you are making a gain or loss at the very first day, so you show it as in your profit and loss. You have valuation techniques now. So valuation techniques we are talking about. So when determining the fair value, an entity shall use valuation techniques. So appropriate in the circumstances, which means that a certain period of time, there are prices which are going up, there are prices which are going down about financial assets or non-financial assets. So circumstances should be considered. For which sufficient data are available to measure fair value. Maximizing the use of relevant observable input, like observable inputs were level 1 and level 2. Okay, so you have to maximize the use of observable input, which means, now observable input means market evidence. Okay, observable input does not mean anything else, it means market evidence. And minimizing the use of unobservable input. Unobservable inputs are judgments, are calculations, are forecasting, analytics. These are called unobservable, and we have to minimize that. Valuation techniques used to measure fair value shall be applied consistently. Consistently means that when you take a fair value of, if you decide to measure fair value of a particular asset, then within that particular category, like if you talk about investment property and you say that I'm going to use fair value model, then all the assets under investment property should be used fair value. So this is consistently. And there are 3 valuation approaches. Market approach, it uses the prices and other relevant information generated by market transactions involving identical or comparable assets, liabilities, or a group of assets, liabilities, such as a business combination, etc. So market approach means that you are taking the market prices of assets and liabilities. You may have cost approach. It reflects the amount that would be required currently to replace the service capacity of an asset, often referred to as current replacement cost. And you may have income approach. It converts future amounts, example, cash flows or income and expenses, to a single current number discounted amount. So, I mean, we did this valuation. If you remember that valuation of business in F9, valuation, business valuation, we have an income approach in which you calculate that how much cash flow will be generated by this business. And then that cash flow, you discount it to current value as of today, and then you assign the fair value. So the fair value measurement is determined on the basis of the value indicated by current market expectations about those future amounts. So 3 things we have. So if just imagine that you are thinking about a business, okay? And how do you give a fair value to a business? Because fair value could be on an asset, it could be on a business. Let's suppose for a business. One way of doing it is that you go and you purchase. So if you want to buy the business by acquiring the shares, so you take, there is a business which has 1 million shares, and each share is $10 in the market. So 1 million shares multiplied by $10, you call it $10 million. Or cost approach. Cost approach means that if I don't buy the shares and if I have to set up a business like this, how much would it cost me to set up a similar business with similar form of assets? Cost approach. Or income approach means that you find out that how much cash flows this business is expected to generate in future, and you discount those cash flows and you come out to as income approach. So three approaches you mostly prefer: market, cost, and income. Fair value hierarchy you talk about. IFRS 13 introduces a fair value hierarchy that categorizes inputs to valuation techniques into three levels. If you remember, level 1, level 2, and level 3, the highest priority is given to level 1 inputs and the lowest priority to level 3 inputs. An entity must maximize the use of level 1 inputs and minimize the use of level 3 input. And of course, in the absence of level 1, you may be using level 2 also. Disclosure requirements. Usually disclosures are not part of your exams. It's not part of your syllabus, but we can discuss. There are extensive disclosures which you need. Valuation techniques and inputs used. So which valuation technique are you using? Income approach, cost approach, or market-based approach? And then what are the inputs you are taking? Level 1 or level 2 or level 3? The effect of measurements on profit or loss or other comprehensive income. For recurring fair value measurements. Recurring means that when you are doing fair value measurements every year, so what is the effect on P&L or OCI? Recurring fair value measurements are those presented in the statement of financial position at the end of each reporting period. For example, financial instruments. You measure the fair value end of every year. Non-recurring fair value measurements are those presented in the SOFP in particular circumstances. Example, an asset held for sale in line with IFRS 5. So you were having an asset under PPE, IS 16, then you classify it as held for sale. Held for sale asset goes to IFRS 5. And when it goes to IFRS 5, you immediately change the valuation method. And you say, now I have to do it on fair value model. Before it was shown at the net book value, balance sheet value, because you were using the asset. Now you have decided to sell the asset. So if you are selling the asset, you move from the entity specific model, you move away from it and you go to market specific model, which is fair value. But this is called non-recurring measurement because it does not happen every year. For this particular asset, it happens this year, that's all. Then you have to give disclosures, fair value measurement at the end of the reporting period. The reasons for measurement for non-recurring, if there are any non-recurring items, the reason for measurement. And like I told that before, we had accounting policy of measuring the asset at cost model. Now, because we classify them into IFRS 5, this is the reason for measuring the fair value. The level in which they are categorized in the fair value hierarchy, which level they are, and description of valuation techniques and inputs used. So these are some disclosure requirements which you use in fair value. Now, what type of questions? Definitely, this is a standard which is very important. I mean, this is something which is a very hot topic for your SBR. You cannot just ignore it. And that's why I spent almost more than an hour on this lecture. But of course, we need to go to the book and we need to see how to apply it. But at least we understood the story, okay?